Welcome everybody to another edition of our Wednesday webinar. And I know top of mind this week is PPP, so we're going to jump into that again. But before we get going, while we wait for everybody to kind of log in, I'd like to tell everybody a little bit about the Kentucky Small Business Development Center. Our program is funded by the U.S. Small Business Administration and handled by the University of Kentucky in partnership with other institutions of higher learning and other organizations. We have 10 offices that cover all 120 counties in Kentucky, and we offer no-cost assistance with market research, opportunity assessments, feasibility studies. We do business plan development and execution. We're really good at financial modeling and projections, and we are great at identifying pre-venture and growth capital that fits your business. Please visit our website at KentuckyBizHelp.com or call 1-888-475-7232 to request one-on-one assistance. We'd be happy to help you. In addition, you can connect with us socially via Twitter, LinkedIn, Instagram, and Facebook. Just search Kentucky Small Business Development Center on each of these platforms to connect. Throughout today's presentation, you'll be able to post questions. So on the right, look for the chat when it comes available. Post your questions. We're happy to answer them. Today, I'd like to welcome our guests. We have great CPAs from Patterson Company. I've known Bob many years. Bob Patterson, who owns the Patterson and Company. What's great about Bob is Bob's not only a CPA, but he has been a business owner for many years in another life, in another industry. And I like that because some business experience and understand how that all works is really important when you're kind of doing everything else. So, Bob, could you introduce the rest of your team today?
I'm sorry, Dave?
Can you introduce the rest of your team today?
I'm sorry.
And meet with you?
I'm sorry. So, good afternoon, and thanks for having us with you today. So, helping me with our presentation today, both putting it together and later on in the presentation. First is Melina Patterson, who is our vice president. She runs the live payroll department. She's the firm administrator, and actually she runs everything. So she is going to be helping us with it. And Andrew Georgial is a CPA, and he is in charge of our accounting services department. And he's played a key part in putting together some of the later slides in the presentation.
Good. So why don't we get started, Bob, because I know everybody doesn't want any more chit-chat. They want to understand what's going on with PPP and forgiveness, right?
We got it. So I can take it from here?
You can take it from there.
Thank you. Okay, everyone. Just got to bring up the... I'm sorry, Dave. I can't find how to move it. Got it. Okay. Sorry. Okay. So for 10 years, our firm, the 10 years that I have owned Patterson Company CPAs, we've been focused on helping small business clients. These are really unprecedented times. I used to think I had seen it all in my career. I've tried to approach all of our clients who we have helped with PPP loans, over 80 now and counting, like it was my own company. We, as well as many other CPA firms, have dedicated people and technological resources to the PPP process. We have found it to be a very unique process. Facts and circumstances matter for almost every loan. There really is not a one-size-fits-all. So first, some housekeeping. Everyone except me and the other two speakers are muted. The slides will be posted shortly afterwards. And if requested, we can email you a copy of the presentation. You can either email us or email Dave, and I'm sure there'll be instructions for that later. So, disclaimers. Again, we're going to share with you all that we have in the next hour, but it could really be outdated by the time we finish this. SBA.gov or Treasury.gov are going to have the most up-to-date and definitive rules. They'll post everything first there. I've really heard this process described a lot as like trying to build an airplane while you're trying to fly it. It really is that way. So be sure and stay very close to your CPA or lawyer or whoever's helping you with this, and get with them the earlier in the process, the better, and stay close to them. So let's put this in context. The earliest forgiveness application will be accepted 56 days after your loan was dispersed. Our first client that got the loan, their loan runs out in 2 weeks. I'm sure some that's a little earlier than that out there, but almost all of the remaining 80 loans that we are involved with will run out within the next 4 to 5 weeks. The Treasury Department issued the very first guidance, which was in the form of the forgiveness application, 12 days ago on May 15th. It was 11 pages long, and we've actually made that handout available for you that you can get later on if you'd like. They followed up with that with interim rules this past Friday night, 5/22. So that's how we got to spend our Memorial Day holiday. I thought though, and I think, aside from being really, really late in the delivery, they've done a really good job with this particular guidance. Unfortunately, the tardiness of the Treasury Department and Congress, probably primarily Congress, is really undermining the usefulness of this to many of the clients, of our clients that were closed or those that are still closed due to regulation. I believe there will be future guidance that will be issued, and changes will likely be made by Congress soon. But today we have to work with what we have, and that's what we're going to talk about. In case you haven't heard, Congress is considering extending the covered period from 8 weeks to either 16 or 24 weeks, as well as loosening some of the other related expenses, but that's for another time. So again, SBA and Treasury will have the most recent information when they do post it on their website, but we'll put a synthesized version on our website when it's available. So let's talk about the intent of the Payroll Protection Program. Let's remember what it was for. When you applied for it, you should have gotten 10 weeks of your eligible payroll amount. Generally speaking, you're eligible for 8 weeks of forgiveness. If you did not deviate from your payroll at all, you kept all your employees employed and paid as before, you have approximately 2 weeks of extra surplus to apply to rent, utilities, and interest on your building. Regardless of whether the money is forgiven, you agree to only use the loan funds for allowable payroll costs, rent, interest, or mortgage, or utilities. It's important to remember that even if it's not forgiven, you're required to spend the remaining loan proceeds on only the allowable amounts. It's one of the certifications you're going to be required to sign when you do the application. So let's talk about the forgivable expenses. There are 4 allowable type expenses for the loan, and also the types eligible to spend the money on: payroll, mortgage, interest, rent, and utilities. Guidance issued on the forgiveness application 12 days ago seemed to restrict some of the payroll amounts, but also seemed to loosen some of the other eligible non-payroll type expenses. Of course, forgiveness cannot exceed the principal amount of the loan, and other eligible expenses cannot exceed 25% of the forgiveness amount. We'll be reviewing this a little bit later. Okay, let's talk about eligible payroll cost. Payroll costs paid and payroll costs incurred during the payroll period are items that can be forgiven. This is better than we originally thought, as it will allow us to accrue payroll earned during the applicable covered period and then pay it outside the applicable period. It's different than we thought initially. So just for definition's sake, the payroll cost is incurred the day it is worked and it is paid on payday, or if you're using direct deposit, the day that the ACH credit transaction is ran. Typically, that's going to be the same day or the night before it's deposited into the employee bank account. So as we'll see on the calendar slides coming up here in a couple slides, in many cases, we'll be accruing payroll costs during the period and then paying it on the next regularly scheduled payday. Here's a visual of the items that are covered in payroll costs: salary, wages, commission, cash tips, vacation, leave, severance agreements, healthcare premiums, the employer paid part of the healthcare premium, and then state unemployment taxes are added to that. We're going to talk about the forgivable part of employee and partner payroll expenses in a few slides. Some of the exclusions are anybody that's making above $100,000 annualized during the covered period. That works out to $15,385 over the 8-week period. Or any employees that you have that are working outside or that have addresses outside the United States. They're excluded. Okay, I mentioned that they gave a different reporting period. The original loan information talked about having to pay everything out in the first 56 days after receiving the loan. And that is the case and remains the case for non-payroll expenses. However, for payroll eligible expenses, the guidance is allowing now 2 options. In some cases, one option may be slightly better than the other from a forgiveness standpoint, but for all practical purposes, the alternate method just offers an easier way to compute the covered expense. Keep in mind that the alternate covered period is only available to biweekly or other more frequent payrolls. Semi-monthly, monthly, quarterly payrolls are not eligible, and before you ask, it's probably too late to change. The forgiveness application asks, what payroll period have you been using? The alternate covered period allows us to begin the payroll covered period on the first day of the next full payroll period after receiving the loan disbursement. That's a lot to say there. Generally speaking, if the payroll doesn't change from period to period, this really will have no effect on the eligible amount. But if payroll is very low when you first got your loan, maybe you had to furlough people at that point, then payroll amounts may go up as you get further away from your loan date. This may, and I stress may, allow you to substitute a lower amount for a higher amount. 2 other items to mention: the alternate covered period gets closer to June 30, which we'll see in a bit as kind of a magic safe harbor date. And it may allow you to have more clarity into what Congress is going to do before you end up spending all of your allowable amounts. It's kind of keep your powder dry strategy. The calendars coming up here in just a minute are going to explain this a little bit further. Okay, so here's the standard covered period. This is what we originally thought it was going to be. So in this case, our loan date was on April 20th. The yellow dates are the 56 days of the covered period. Our pay dates are in red. We've got the 30th, the 14th, the 24th of May, and the 11th of June. Our applicable period is going to end on June 14th. So in this case, we're going to pick up those 4 full payrolls and then accrue June the 7th through June 15th and then pay it on June 25th. So Moving to the alternate covered period, I'll let you look at that just for a second. Using the same loan dates, you can see a couple of differences here. While the loan starts on April 20th for non-payroll expense, the alternate covered period for payroll will not start until the first day of the next full period. In this case, it's Sunday, April 26th. We'll then pick up the same 4 pay dates as well as the full pay period ending on June 20th, which is then paid on June 25th. You'll see later on that this case provides a slightly better forgiveness amount, but that's not going to always be the case. In some instances, it'll actually be less. It really is a facts and circumstances case-by-case analysis. Here are the 2 calendars side by side. Again, if you've never changed your payroll amounts or your full-time equivalents, then likely either of these will work equally well. If you had laid people off, or you reduced people, or you reduced the hours at the beginning of all of this emergency, you may be better off with the alternative method. Fortunately, your payroll provider should be able to supply both periods for comparison when you do the application. However, for planning purposes, you need to be looking at this now before you get further into later weeks. Okay, here's a big change. Significant change from the original expectation came down with the application and the guidance. Eligible owner compensation is now, well, I say now, it is capped at the lower of $15,385, which is the $100,000 annualized for 8 weeks, or 2019 W-2 earnings, or partnership self-employment earnings less Section 179 expense. So that's a big change from what many of us thought it was going to be. This change would have really been great to have known, or this information is a better way to put it, would have really been great to have known prior to us putting together the plans, but it is what it is. On a positive note, thus far, there have been no family attribution limits imposed yet. What that means, if a spouse or other family member is employed by the company, that spouse or family member, provided they are not an actual owner, is treated like any other employee for these purposes and can be paid as any other employee. Let's hope this remains the case. I know of several clients in which family members were the only ones showing up for work because of fear, or because of the unemployment benefit structure, or because of the fear induced by the unemployment benefit structure. So seems only fair that they would get paid. So again, W-2 income for S Corp owners or C Corp owners, self-employment income less Section 179 deduction for partnerships. Okay, so moving past the payroll costs eligible for forgiveness, recall that the other eligible costs are rent, interest on mortgages, and utilities paid or incurred in the covered period. Remember, the covered period is 56 days from the day you got the loan. The guidance prohibits prepaying expenses, but it does appear to allow catch-up payments of eligible costs, such as unpaid rent or utilities. This is a potential significant opportunity for companies which were unable to pay April 1st rent because they were shut down perhaps, or had no revenue coming in. We believe those amounts are going to be eligible for forgiveness. The SBA believes this will ultimately be a de minimis amount, as these costs are limited to 25% of the total forgiven amount. Costs incurred up to the last day of the covered period are eligible to be forgiven, provided they are timely paid on the next due date. This means that, using our example from before, the origination date was April 20th and the standard covered period ended on June 15th. You could accrue 15 days of utility payments from June 1st to June 15th and then pay it on July 1st when it was due, or whatever the next due date is, and it would be eligible for forgiveness. Just an additional overview of other eligible costs. Remember, no prepayments are allowed, limited to 25% of the forgivable amount of the loan. Count the costs incurred and the costs paid only once. And it's very important that the costs that are incurred towards the end of the forgiveness period are timely paid to assure the forgiveness. So with that, let's move on to the various reductions in forgiveness. Generally speaking, there are multiple areas of reduction of forgiveness of the loan. Probably the two most notable on the reduction of the forgivable payroll costs are the FTE reduction and the wage reduction. Till the application was presented on May the 15th, no one really knew what the wage reduction calculation was going to be or what it was going to look like. While what they announced is potentially significant, it could have been worse. What will be significant is the documentation that you'll have to provide to the bank to prove that you did not cut hourly pay or annual salary during the covered period or the alternate covered period as compared to the base period of January 1st through March 31st of this year. If you didn't make any changes here, this part may not be all that difficult. On the other hand, if you did, you're going to need to calculate and document through payroll records what percentage hourly pay or annual salary was reduced. And this is done by an employee and by employee basis, on an employee by employee basis. And your payroll provider will need to supply lots of documentation here. Generally speaking, you compute the hourly rate by the hours worked in the covered period or the alternate covered period and compare that annualized amount to the annualized same calculation for Q1 of this year for each employee. The process is essentially the same for salaried employees. Annualize both time frames and compare the amounts. If the covered period or the alternate covered period amount by employee is less than the annualized amount for Q1, then there's a dollar for dollar reduction in forgiveness. Calculation itself is fairly straightforward on the forgiveness application. It will begin on page 7. Again, you've got that application in your handouts. It's a multi-step process, but I encourage you to take an easy example of just one fictitious employee making $10.25 an hour for 30 hours a week in the base period of the first quarter of this year. Then let's hypothetically say that you reduce their pay by $3 an hour at some point in the covered period, making their pay minimum wage $7.25 an hour, or roughly a 30% reduction. Let's assume further that their hours were not reduced, just their hourly pay. It's a different calculation if you also reduce their hours. Remember that if you had only taken their pay to something above $7.70 an hour instead of $7.25, there is no reduction required because you're allowed 25% reduction before anything happens. But you went all the way down to $7.25 in this example, and you didn't restore by the magic safe harbor date of June 30. This means that you'll have a 45 cents per hour forgiveness reduction for this employee. $7.70 an hour minus the $7.25 an hour times 30 hours times 8 weeks, $108 for that employee. And that's a dollar for dollar reduction off of your forgiveness. Salary calculation works the same way. It's actually a little bit easier because in theory, there are no hours to compute. Now, two things here. All of this can be avoided by fully restoring all the hours and rates of pay to all the employees not later than the payroll period, which includes June 30, the magic safe harbor date. Secondly, all of this happens before the full-time equivalent forgiveness reduction. which this ordering method is significant because it's more borrower friendly, because the wages are reduced, if there are any reduction in wages, before the full-time equivalent reduction takes place. So I encourage you, go to the instructions on page 7 and work through it with one employee. It'll take you about 5 minutes to figure it out. And then once you get all the documentation from your payroll provider, you'll understand more about how that's going to happen. Okay, moving on to what I think is the more significant reduction, the full-time equivalent reduction. It has the ability to significantly reduce the amount of forgiveness. In theory, if you have less full-time equivalents in the covered period or the alternative covered period than you had in the selected base periods, and the selected base periods are 2, February 15th through June 30th of 2019, or January and February of 2020, or your 2 base periods you can choose from, then the eligible payroll expense after the wage reduction calculation would be reduced by the percentage of reduced full-time equivalent. I don't know an easier way to say that. As a simple example, maybe this is it. And as a simpler example, if you had 10% less full-time equivalents in the covered period than you had in the selected base period, your forgiveness would be 10% less, generally speaking. Change was made in the full-time equivalent formula with the guidance. Originally, it was thought that the full-time equivalents would be 30 hours per week, which is the ACA standard that we had from 7 or 8 years ago. Guidance, though, made it clear that it's going to be a 40-hour week as the full-time equivalent. Using this, you take the average hours per week per employee up to 40, nothing above 40, and divide it by 40 and round to the nearest 10th. So again, if they're 42 hours, only 40 counts. You would then add up each employee by week and compare to the selected base period. Again, the January and February of 2020 or February through June of 2019. This is going to require another document dump by your payroll provider and some calculations to determine all these numbers. There's also a simplified method, which may or may not be all that simple. It allows you to count all employee average hours of less than 40 as half of an employee, and those with 40 or more hours as a full employee. You would do this for all the covered periods and all the base periods to determine the best ratio. Simplified method might work in your favor if you have a lot of part-time employees working less than 20, 25 hours a week, based on what we've seen. Okay, there's been a lot of concern about people not coming back to work because of whatever reason. You let them go, you furloughed them, and now you tried to get them back and they're not able for whatever reason to come back. So they did put guidance in here, which was really good, to allow you to not get penalized for these full-time equivalents, provided you have given them written documentation that you're a bona fide job offer, and they have said, I'm not coming back. And you have documented that to the file as well as to the state unemployment office that you offer the job, they're not coming back. If you did not then replace that full-time equivalent and you have this written documentation, then it's not going to count against you when you do the calculation. This is a really significant exemption and will be an important piece if you're unable to get all of your employees to come back to work. So the big safe harbor reduction for this is if you had a reduction in full-time equivalents between February 15th and April 26th of 2020, this year, if you reduced your full-time employments in that time frame and then you restored back to your February 15th full-time equivalent levels by the pay period, which includes that safe harbor date again, June 30, then regardless of what happened in the 8 weeks prior, this does not count against you. So potentially, it could be a disaster right now, but provided you've restored by the end of June, then you will be fine. If you're ever able to bring these people back or their replacements back, even if it's minimum wage, you need to be looking at that, or I would encourage you to look at that. Okay, I know we probably already got 100 questions of does the EIDL Advance count? So the EIDL Advance, the Economic Injury Disaster Loan Advance, reduces the amount of PPP forgiveness, and it's part of the formula. We'll show it to you when we get a little bit further. But it is on the application. It's on page 1 of the application. You have to actually list your EIDL loan number and how much you got, and it's a reduction. Okay, so let's look at this calculation sheet here. Some of you may recognize this prominent company, Vandelay Industries. Vandelay had an original loan amount of $100,000. They had 10 full-time equivalents. Their base period, their default period, they had 10. That's January and February of 2020. Their alternate period, they had February 15th through June 30th of 2019, they had 12. They got their money on April the 20th, which makes their 56-day forgiveness period run through June 15th. So in this case, their wages, they actually reduced wages, but they were smart enough not to reduce the wages more than 25%, but their wages are less than they would have, or less than they used to be. And so their gross wages are paying out at $13,000 or $6,500 a week, $13,000 every bi-weekly payroll. At the end of it, if you remember on that standard covered period that we showed initially on that calendar, there were 6 or 7 days that were accrued for. That's being picked up here in this calculation on week 8. It's actually going to be a separate payroll, as you remember. I think paid on June 25th, but we're picking up for sake of this calculation, we're putting it into week 8. We would add retirement or health benefits. That is the employer cost for retirement benefits or health insurance benefits. That would go on the next line. The next line is state, local employer taxes. That is your state unemployment. We plugged in $25 just to show something there. The wage reduction is this next line, and again, that would come off of the calculation that we went in depth in. If you reduce the wages more than 25%, in this case, we did not, so there is no reduction. The EIDL loan advance up to $10,000 goes on the next line. And then the next deduction is wages that are prorated, wages that were paid out that make over $100,000 prorated, or $15,385 is kind of the number. And then any wages that were paid out through the Families First Coronavirus Act that came out before the CARE Act when it all first started. And then any non-resident employees that you have that are residing outside the United States. So Vandelay had no deductions for those 3 things, and they are finishing with $60,000 of payroll expense. So it's 60% of the loan amount. We originally thought that it was going to be cliff vested, or if they had less than 75% payroll, that they would get nothing. But the guidance made it clear that's not the case. So at the end of the day, right now, if they had nothing else, they would get the $60,000 forgiven. They ended the full-time equivalents for the 8 weeks, either through the 8 weeks or they restored everything by June 30, one or the other. Anyway, we're counting them for 10 full-time equivalents. So they had 100% of their full-time equivalents here. In this case, Vandelay has rent of $7,000. That could be, you know, their building rent. That could be their car rent. If they have a company car that's registered in the company name, or if they have equipment leases, that could be that are registered in the company name. That could be included here. Mortgage interest would probably be in place of the lease payment, but that could be a car payment. If you're financing the car, again, in the company name, then that could be included here. Utilities for month 1 and month 2. In this case, we had $500 a month in there. Anyway, Vandelay is going to end with $15,000 of other qualified expenses. So they've got $60,000 of payroll expenses, $15,000 of other qualified expenses, and they have no other deductions. So they're going to end up with $75,000 forgiven. They're going to end up with almost $25,000 left that they have to make a decision on what to do with that number. They'll either keep it and spend it on other approved items later on and take it as a loan, or they'll send it back. There is no prepayment penalty on the loan back to your bank. So I wanted to show quickly the alternate covered period, which is what we showed earlier. And there is a small difference in the amount. It's in this case $5,000 versus, or $65,000 versus the 60 in the standard method. But you just see where it's a little bit cleaner. It's picking up 5 full periods of payroll. There's nothing to estimate, nothing to accrue. It's just we had the all the different pay dates, and then that last payroll ended, I think, on the 20th of the month, and then it's paid on the 25th. So in this particular case, they're going to end up with $5,000 more forgiveness. So end up with a slightly smaller loan. So I do want to point out the $15,000 in other qualified expenses is 25% of what the forgivable payroll amount is, roughly. So there's maybe a little bit of room to play with there, but remember the other qualified expenses are limited to 25% of the forgivable part of the loan. Okay, so there's all kinds of documentation you're going to have to give besides those calculations. We won't spend a lot of time on it, but it's pretty self-explanatory. You're going to have to show a lot of cancel checks. You have to show a lot of payroll reports. And your payroll company can help you with a lot of that. You're going to have to show a lease. As we'll see here in just a minute, you have to show lease agreements. So you ought to start pulling that stuff out prior to starting the loan forgiveness process. The local banks did a much better job, I thought, of pushing through the loan approvals for the small business owners. Hopefully it'll be the same for the application for loan forgiveness. The lender, SBA lender guide says they can use the SBA forgiveness application or the bank equivalent form. It was the bank equivalent form that caused us so much heartburn when we did the initial application. Hopefully the larger banks won't make it so difficult in the forgiveness process as they did in the application process. So the items on this and the next 2 slides are things that you're going to have to get together and keep. Some of it most of it you're going to have to turn in. A lot of it you'll have to keep for in your records for 6 years. So here's more of it. Something to note here is they are going to be asking for payment receipts, payment proof going back to February of 2020. That's going to be part of the process. So just be aware of that and be looking for it. Okay, so this information is stuff that you're going to have to keep for 6 years after forgiveness. This slide, this stuff is not going to the SBA or not going back to the bank for forgiveness, but it's stuff that you've got to keep in your file, and you're going to assign certifications to this effect that you have this information and it adds up to what you say it adds up to. You're going to keep that as part of your documentation for later. Okay, so what if it's not forgiven? Don't rush to complete the application. In most cases, you're going to want to wait at least until June 30 for the safe harbor, depending upon when your loan runs out. But you've got 60 days available afterwards to submit the application back to your bank. Then your bank has 90 days to respond. If you don't like what the bank says, you can appeal that decision to the SBA. If you've got all your information and you've done it right, it really shouldn't be anything for them to question, but you do have that appeal process. So just also remember, it's important to get it right, to make sure that you are accurate and honest in your answers. While you're not turning everything in, you're still certifying that you got it correct. Remember that knowingly making false or misleading statements can result in the cancellation of the forgiveness. That's small compared to worse, potential federal charges, including potential imprisonment of 5 years. There's nothing that you're going to borrow here that's worth 5 years. So make sure you got it right before you sign it. If you have some left over, it's got to be repaid. And Andrew's going to talk about that now. Take a few minutes walking us through what that's going to look like. Andrew?
All right, thanks, Bob. So as Bob said, we'll look down here at this last point on this slide real quick, is that the loan has to be paid back over 2 years with the 1% interest, but with the first 6 months being deferred, we're only actually going to amortize the loan over 18 months. So one thing that we're going to be wanting to do is, trying to, calculate and forecast what your cash flows are going to be looking like, because, as this time, your cash flows are going to be extremely important, while less money is coming in, with operating at a limited capacity. So we want to take our beginning cash balance, add in our projected cash inflows, and then obviously subtract our projected cash outflows. After that, we'll actually also calculate a burn rate, which is how quickly you'll use your cash reserves. We'll look at that here in just a minute. So if we continue on with our example with Vandelay Industries, you see that we're starting out with $40,000 of cash, on hand. We've got some sales plugged in here. We've got some expenses plugged in, pretty typical. So now we're showing here that we're actually down to $14,500 of cash after 3 months. So if we start looking at the cash burn rate, so we're beginning with our $40,000, we're down to $14,500. That's a difference of $25,500. So we're actually burning through $8,500, each month, and that can be a lot of money, during these times. So if we look at, if we're starting out with $40,000, we're using $8,500 a month. We only have close to 5 months before we run out of money. So what we're hoping to do is, be able to, give you some other examples of how to, try to manage that cash flow. Might try to request the rent deferrals. The banks, may be a little bit lenient on, changing up the payments. If you're used to billing out every month with accounts receivable, hey, maybe you could potentially even do it weekly to improve, cash coming in quicker. But there's our examples here of Vandelay will have available to you so that you can be able to plug in your own numbers, and we're just hoping to be able to assist you all and during these times as best as possible.
Okay, Cool, Andrew. Thanks. So, Dave, I think we've got some questions.
Yes, we do, Bob. We have lots of questions, actually. Number one question that I'd like to ask first, because we get this a lot, is can you get both a EIDL loan and a PPP?
So, I doubt anyone asked that question, Dave. That is a very common question. And yes, you can get both, but you can't use it for the same thing. And you likely got a grant of $1,000 to $10,000, $1,000 to $10,000 when you applied for the EIDL loan, and that part has to be shown on the PPP application, and it is not forgivable. So it can only be forgiven up to the PPP loan amount. So, but you can have both loans. You just can't use it for the same things.
Yeah. So another question I get a lot, because there's a lot of confusion with what's coming out from the Treasury Department and the SBA, is this idea of what can I do with the money if I don't use it all for the forgivable part? Like, if I don't have enough employees come back to spend all that money, what if I have, like in your example for Vandelay, I have $25,000 left over. What if I use that to pay for a non-allowable expense? Let's just, whatever it is. Let's just say I have to pay for some sort of repair, for example, that was kind of expensive, which is not an allowable expense. What happens what happens there?
Well, I'm not really certain what will happen, but I know when you sign the forgiveness application, you are certifying. When you sign the original loan document, you certify that you are only going to use it for the allowable expenses. And when you sign the forgiveness certification, you are certifying that you've only used the money and will only use the money for allowable expenses. How that, what happens after that, I'm not certain, but those are the certifications that you will be making.
Right. And I know we're just spitballing some opinions here because there is no clear guidance here, but what if I use that to pay my rent ongoing after the 8-week period? What would your thought process be on that?
I think that's allowable. In my opinion, that would be one of the allowable expenses. Again, you're taking a loan to do that, so that's another question. But I think it is allowable, and you could do that.
Right. It just wouldn't be forgivable, but it would help you with your working capital needs for certain expenses. Then, right?
Exactly. Yeah.
Tony, are you there with me today?
Yes, I am, Dave.
What kind of questions do we have today?
We have a lot of questions around the full-time employee questions, so I'm going to go ahead and get started on those if you all are ready.
Mm-hmm.
Okay.
All right.
So there are, let me see here, Kelly Napier. She asked a question. She says, hey, there are several requested reports based on different date ranges in the PPP loan forgiveness application. Her first part is, A, may we alter these dates ranges to match up with our actual 2-week payroll periods in an effort to simplify an already cumbersome process?
Yeah. So I think the SBA heard you on that, and that's why they are allowing the covered period, the alternative covered period that you can use to count your FTEs. Again, you've also got the same, the fallback position of the safe harbor on June 30 if you're not able to restore. As far as the base period goes, that you're comparing to the January and February of 2020 or the February 15th through June 30th of 2019, those are set in stone, at least as they are now. And so that's what you have to use as your base period to compare to.
So, Bob, can I piggyback on that? She says, what if your covered period started before the April 26, 2020 ending date of the full-time employee reduction period? It's in reference to that safe harbor for the FTE reduction.
Yeah. That's a good question. I don't know the answer to that. I would more research have to be done on that one.
Yeah.
Okay. So the next question comes from Charlene Wilson. She wants to know, this is about the forgiveness to the lender. Is there a time frame after your 8-week period ends to request loan forgiveness from the lender?
So generally speaking, I think you've got 60 days after your loan ends to put together your application and present it to your lender, and then they have 90 days to examine it and approve or deny your forgiveness.
Okay. Can I continue on, Dave, or do you have any questions?
Well, I've got a question because this is kind of interest to self-employed and contractors. When they calculate their net profit on the on whatever it is, their self-employment or their single member LLC, and they use the 8-week out of 52-week revenue calculation. Can they add their paid health care on top of that, as well as any unemployment taxes if they're W-2 and their 401k contribution? Does that work with contractors and self-employed?
So there's still some gray areas on the Schedule C type of filers or borrowers, if you will. But in my opinion, you're not able to add those things back for Schedule Cs because that's part of your net self-employment income at the end of the day. I think it's line 31 on Schedule
Right.
C. That is actually what your net income is after all of your expenses. So I don't think you can add it back on a Schedule C.
Gotcha. Okay, Tony?
This comes from Rhett Barber. Do my full-time employees have to be the same at the beginning of the loan and at the end of the loan to be forgivable?
I don't think it has to be the exact same employees, but it does have to be, a similar number for it to be 100% forgivable.
So, okay. The next question is, I think you all answered that one, but I'm going to ask it anyway. Can self-employed individuals calculate the 8 by 52, then add self-paid healthcare premiums, state employment taxes, and 401k contribution as the employer portion?
Yeah, I think that's what we had talked about earlier. I don't believe that you can there, but again, we expect more guidance on the Schedule C filers.
Okay. You may have covered this, but Rosie wants to know, is travel time paid to employees considered to be forgivable?
Is travel time paid to employees? I think that if you're paying them, it's part of the payroll expense. I don't see why it would not be. I don't know that I'm understanding that question totally, but if anything that you're paying the employee, part of their payroll, I think would be covered as long as they are meeting the other eligible criteria and they're making less than $15,385 during the 8-week period.
Okay.
I got a question, Bob. So the $100,000 per employee, exclusion barrier there, is that just gross wages, or does that also include any benefits on top of that, like 401k match and health insurance?
So there's some gray area there. There's been a lot of questions on that. I believe that for like S corporation owners, that you probably cannot add that back, but there are a lot of people that think that you can. I think there's going to have to be more guidance for that. One thing I left off on the slide, though, you just reminded me, or that I left off on my comments, is that $15,385 is across all entities. So if that business owner owns more than one company, they can only do $15,385 across all of them.
Gotcha. Well, that piggybacks another question for an S corp owner. I believe there is either on the EIDL, I think it's on the EIDL loan, where there's a prohibition on, it's prohibited to make distributions to the owners, distributions to the owner. S corps usually distribute money for taxes annually. Is that allowable or excluded, do you think?
I think that the company can make distributions to the owner, but it's not going to be part of the forgivable expense.
Good. Tony, got a question?
Because it's not a W-2 income.
Gotcha.
Yes, Dave, I do. Diane Showalter, she says, we paid annual bonuses during during quarter one. If we continue to pay our employees their normal hourly or salary, can we be penalized due to the 75% threshold on the PPP?
So if I understand that question right, their W-2, their income was probably inflated in the first quarter because they paid bonuses from 2019 in the first quarter, and that's being used as a base period. That's a very good question. And I would have to do more research on that. Off the top of my head, I think there's, I don't know. I don't know. That's a better way to put it.
Understood. So, this question comes from Chrissy. She says, so what would happen if we didn't use all of the 25% for utilities?
We did not use all of the 25% for utilities. Of course, that's one of the 4 non-payroll related expenses that you can use. So hopefully you could use it for something else. You know, whatever you don't use, in theory, you would either turn back into the bank or turn it into a loan for the 18 months, provided you're using it for other forgivable expenses going forward. I'm sorry, other allowable expenses going forward. It's not forgiven.
Can you clarify how many pay periods are covered in the covered period? I'm getting a couple of people that are asking that same question.
Yeah, okay, that's a good question. So I would encourage you to go back and look at those calendar slides because it does. I'm a visual person, and so it helped me better understand it. But so it's the number. It's every pay period that you have between the start date and the end date, plus if you're using the standard covered period, you're going to likely accrue for some number of days at the end, and then that would be paid outside the covered period in the next payroll. So it really just depends on the dates and how they all fall. But I would encourage you to take an Excel calendar and just map it out like that with your dates, and it'll become clearer to you.
Tony, I got a question from Clarissa, and she's obviously done her homework because she asked, she says, page 7 in that application states you should not include owner employees. Will you please explain where you would calculate this info for this person on the app? For example, S Corp and the owner is listed and paid as a W-2 employee.
Yeah, that's a very good question. There is actually a separate line in the application for owner partners, if you will, and that's where their income would go.
Thank you. Tony?
Yes, thank you. Jim Klicka says, how do you calculate if an employee leaves in the middle of the 8 weeks?
I'm sorry, can you say that again, Tony?
Sure. How would you do your calculation if you have an employee leave in the middle of your 8-week period?
Well, so, it depends on, part of it depends on how did they leave. But if they just left, then you want to make sure that you document they left on their own, and that would become part of your forgiveness calculation to, so it doesn't count against you. If you allow them to leave on your volition, then you would want to document that you asked them to leave. But I think the documentation and the exemption that they're going to allow for people leaving would help you with that.
Mm-hmm.
Thank you.
Bob, I got a question because I get this one a lot too. Is and actually Alan asked this: if you do not receive your funds until, for example, May 7th, does that 56-day period extend past the June 30th deadline?
I think it does. I believe it does.
Yeah.
I think it has to.
Yeah, we've been hearing there's still funds available if you haven't applied for a PPP loan and feel like you need one. I think it's the right thing to do is go ahead and apply right away while there's still funds available.
I agree.
So I have this question, Bob. It says we have salesmen earning commission as subcontractors. We received our PPP loan when subcontractors were considered to be a part of the calculation for their loan amount. They want to know what will happen now that they've heard that subcontractors are no longer a part of that calculation.
Yeah. And that is correct. Subcontractors are not part of the forgiveness. They have to collect W-2 income to count in this payroll protection program. I think that they're going to be left with a certain amount of available dollars that they would either turn back in or convert it to a 1% loan.
Bob, can you clarify that the number of pay periods, is that actually based on how many normal pay periods you would have in an 8-week period? Like if I pay weekly, then I would have 8 actual pay periods. Is it set up like that? Because I have people asking for clarification on the number of pay periods.
Sure. So if it is a weekly payroll, then and you use the alternative covered period, you would have 8 payrolls because it would fall in place. If you're on a biweekly payroll, then it may or may not fall into place on the standard calculation or the standard covered period. It may or may not fall into place on the alternative covered period. You're going to have at least 4, and probably would be 4 because that's why it's there, is to try to make it easier from an administrative standpoint. Again, go back to that calendar and just plug your dates in. And I think it will make more sense.
Thank you. I appreciate that. Dave, can I ask one more question?
You sure can, Tony.
Okay. So, Bob, this is actually, I think this is just a general question. They said, hey, can interest on a bank loan for inventory, is it deductible?
I don't think it is. What I have read, I believe it has to be some type of personal property or real property, like a warehouse or office, or a lease on a warehouse or office, or a lease on a car, those types of things. And it has to be in place prior to February 15th. On a line of credit, that would be used for inventory, that's changing every day. It might be, I would ask your CPA or advisor helping you with that. They may do it. Off the top of my head, I don't believe it would be.
Okay.
Bob, another quick question here that we do get a lot is this definition of utilities, and we can figure out the easy one with electricity and water, let's say, and gas. But what about a phone service, or if the company pays for cell phones for everybody, or internet service? What else would be included other than the obvious?
Yeah, so I believe that internet service is covered. I believe that cell phone service for the company, a lot of companies operate just on cell phones. I think that would also be covered. Trucking companies may have fuel expense for their trucks. That would, I believe that would be covered under the transportation part of it. So I was on a webinar last night that they were talking about the potential of putting in workers' comp expense into the payroll part of it, just to go off. I mean, I think those are questions that you need to ask your CPA and get them to research that. But I think there's more there under the surface if we just keep digging.
Mm-hmm. Yeah. Tony, want to ask one more question?
Yes, this has actually been asked quite a bit in response to single member LLCs. They want to know about how does the forgiveness apply to them? if you have any tips for that.
Okay. So I'm assuming when they say single member LLC that they're a Schedule C filer versus a S corp. Or so generally speaking, their forgiveness is going to be limited to 8/52 of their net income. At the end of the day, there's not a lot of guidance on Schedule C filers yet. I expect more to come, but that's the piece that they really haven't filled in the gaps. If you remember, they didn't actually issue the guidance on the loan application for Schedule C filers until several weeks into the process. So for some reason, they run late on that one.
Thanks, Bob. Well, we're getting a little late in the day here, so I guess we should call it a day. Bob, Andrew, and Melina, I want to thank you guys for sharing your vast knowledge today. This is a tough subject. Everybody's facing a lot of questions, and as we often say, what we tell you today may not be right tomorrow. So keep your eyes open. As more guidance comes out, things can change quickly. So, Tony, you want to say anything?
Well, I would like to thank Bob, Melina, and Andrew as well. You all have done it. Your presentation was excellent, and I appreciate you all handling all these tough questions. We really do appreciate that. And thank everyone for being a part of our webinar today. Thank you all.
And also, later on today, you'll receive an email with more the links to the files and a download for the slides and the replay if you'd like. So you can kind of replay this over and over again. One pass is probably not enough. So, Bob, Andrew, Melina, thanks for your time today, and thank everybody for joining us today. We really appreciate another Wednesday with you, and hope to see you next week. We'll be talking about e-commerce next week, how to pivot your business and try to draft some sales from an e-commerce standpoint if you're not already done so. So we'll see you next week. Goodbye, everybody.
Thanks a lot.